the time is now good to enter commodity-related stocks. They're very depressed. I think they may go down another 20%. But my nightmare scenario is that financial assets go down 80%, not just 20%. So I think the commodity space is relatively interesting. Number two, within commodities, we have some commodities that are relatively expensive. I would say that, as I explained earlier on, gold is relatively high. I'm still buying gold, but I think it's relatively high. But agricultural commodities are now extremely depressed.
Marc Faber, a revered economist known for his discerning market forecasts, champions gold and silver as essential safeguards in an unpredictable global economy. He sees gold's sustained value and resilience during economic downturns as proof of its indispensable role as a hedge against inflation and currency devaluation, reinforcing its status as a financial safe haven. Silver, Faber points out, uniquely bridges the gap between precious and industrial metal, gaining from its historical significance and increasing demand in technology and industrial sectors. This blend of utility and value positions silver as an attractive asset for investors looking to combine the safety of precious metals with the growth potential of industrial applications. Faber advocates for the strategic inclusion of gold and silver in investment portfolios, viewing them as more than mere assets, but as vital components for diversification and protection against market volatilities and the diminishing value of paper currencies. His approach underscores the enduring significance of tangible assets in achieving financial stability and growth. Now we'll show you the best clips of Faber, but first, hit the like button, smash the subscribe button, and check our pinned comment for some massive sign-up bonuses for traders. Enjoy the video.
And I'm constantly adding to my gold position. I've never sold any gold. I just keep on adding little by little. But the gold price has performed, say, reasonably well compared to the consumer price index over the last 50 years. If we take as a starting point 1971 or 1970, the gold price was at $35 an ounce, and now it's around, say, 2,000, okay? Prices of an item whose quality has never changed, say like a Campbell's soup. Well, I suppose the quality has gone down somewhat over the last few years because maybe the quality of tomatoes has deteriorated, but it hasn't been subject to a huge technological change. That price hasn't gone up as much as the price of gold. As an example, the price of a house has probably gone up somewhat more than the price of gold, depending where the house was. If the house was in South Africa, probably not. But if the house is in a good location in Los Angeles or in a luxury apartment in Manhattan, then the price has gone up enormously, also rents. But what I want to say is that gold, some people have complained that gold hasn't been such a good investment. Well, it's not the best investment in terms of return because it is relatively safe. That's physical gold held in a safe deposit box or under your mattress at home or in your garden or whatever. On the other hand, gold shares have not only gone down absolutely in the last few years, but enormously relative to the price of gold. Say, I can take the price of gold at 1,000 at the low in 2015, and the price of gold shares at the time, price of gold shares now, and the physical price of gold. And I can say that since 2015, gold shares have either gone down or not up. So the underperformance is incredible. There are reasons for that. Number two, the underperformance of gold shares relative to the S&P 500 is mind-boggling. I mean, that this could happen is incredible. Oil has also underperformed the S&P 500 and value stocks anyway, and emerging markets anyway. But gold shares have underperformed in a spectacular way. And therefore, I think that if I look at the price of gold and the price of gold shares, I think a lot of these shares are relatively low.
In today's market news, silver price analysis, silver plunges to $24 after stubborn U.S. inflation report. Silver price falls vertically to $24 as sticky U.S. inflation allows the Fed to maintain a hawkish narrative. U.S. monthly headline and core inflation rose by 0.4% in February. On the other side, 10-year U.S. bond yields rally to 4.15% as hopes that Fed rate cut expectations would ease. Silver price plummets to $24.10 as the United States Bureau of Labor Statistics has reported that the Consumer Price Index remains hot in February. Annual core CPI that strips off volatile food and energy prices grew at a higher pace of 3.8% against the consensus of 3.7%, but lower than 3.9% in January. In the same period, headline inflation rose at a higher pace of 3.2% against expectations and the former reading of 3.1%. The monthly headline and core inflation grew by 0.4%. Quick recap of silver technical analysis. Silver price faces selling pressure after testing the horizontal resistance plotted from the December 22nd high at 24.60. The overall trend is still bullish. However, a price correction move is expected before a fresh upside move. Is this dip a once-in-a-lifetime opportunity? Drop a comment, like, subscribe, and check our links in description for some massive bonuses. Let's get back into the video.
The time is now good to enter commodity-related stocks. They're very depressed. I think they may go down another 20%. But my nightmare scenario is that financial assets go down 80%, not just 20%. So I think the commodity space is relatively interesting. Number two, within commodities, we have some commodities that are relatively expensive. I would say that, as I explained earlier on, gold is relatively high. I'm still buying gold, but I think it's relatively high. But agricultural commodities are now extremely depressed. They are now at the level relative to the commodities index and relative to the consumer price index that is extremely depressed. So I think that it wouldn't be a bad idea to buy rural properties and to buy companies that would benefit from an increase in the price of wheat, corn, bean, and soybeans. Say countries that would benefit from it would be Latin American companies. Yes. Oil stocks, say you take the peak of the oil mania, when everybody was investing in oil and resource stocks instead of tech stocks in 1980. There was a huge bubble in energy stocks. Most prominent among them was Dome Petroleum. Nobody knew what the value would be, but people bought it because it kept on going up. Anyway, at that time, oil and energy combined was about 33% of the S&P 500 index. Now, the energy sector, I've read somewhere that recently Apple alone was worth more than all energy companies in America. Now, as a percent of the S&P, they dropped and are less than 5% of the S&P 500 at the present time. So again, relative underperformance that is colossal. Now, I do agree with some of the views of the environmentalists and I think we should clean up our environment and so forth. But it doesn't make sense to use an electric vehicle, go to a charging station that is powered by coal generated electricity or by diesel engines at the power station. Doesn't make any sense. So my view is the madness of some of these environmentalists will actually increase the demand for oil, because if you produce windmills and blades for the windmills and so forth and so on, if you go and mine for copper, you need oil to generate the energy to do that. Plus, the global economy now is not performing well. But once the demand for oil increases more in India, because we can look at the per capita consumption of oil, say, in the United States, in China, in Saudi Arabia, and in India. In India, the per capita consumption is about less than 7% of the US per capita consumption. And India is an economy, who knows how far they will grow and so forth. But at the present time, the trend line grows, and I think it can be maintained for a few years, will be around 6-7% per annum. So the oil demand from emerging economies will grow up, will increase. The supply won't go up very much because no new major oil fields have been found, and exploration is very expensive. And technically, at the present time, the commercials sector, in other words, the ones that know about the oil market, they have reduced their short positions and are at a low level that is usually associated with market bottoms for oil.
What do you think of today's show? Do you agree with Marc? Will gold and silver have a huge year in 2024? Post in the comments section your price prediction for the gold and silver for the end of 2024. Subscribe if you have not yet done so, and watch this video right here because you'll love it. I see you on the other side.